Okay, so welcome to today's webinar. I'm Darren Sugiyama, founder and CEO of Lionsmark Capital. Our office has been flooded with requests from advisors all over the country that wanted to see a demo of our premium financing capabilities. So it's been kind of a challenge to meet with every single advisor that wants to learn more about our firm. So we thought it would be more time efficient to produce this pre-recorded webinar that takes you through who we are, what makes us different, and how we do business with advisors just like you. I'd encourage you to take notes or jot down any questions you might have. And at the end of this webinar, the person that invited you to attend will coordinate a private Zoom meeting where we can meet each other, quote unquote, live via Zoom to see if this is a good fit for us to work together or not. We do have certain requirements regarding the advisors that we give access to our premium financing platform. So when we do meet, I'll have some questions for you as well. So let's go ahead and start with a quick 8-minute video that explains 3 very distinct offerings that we have that no other premium financing intermediary has. And then we'll get our webinar started. I'm Darren Sugiyama, founder and CEO of Lionsmark Capital, the most transparent premium financing intermediary in the life insurance industry. In business, you must have a great USP or a unique selling proposition that answers the question, why should someone do business with you, only you, and nobody else? Well, at Lionsmark Capital, we have 3 key things that make us unique, things that no other premium financing firm does. The first one is that we have multiple financing platforms. The premium finance life insurance should be a highly personalized solution. And while most firms take a one-size-fits-all approach, that we have 5 different core lending platforms, each one built for a specific type of client, based on their net worth, their cash flow, liquidity, risk tolerance, and the type of business they're in. Now, some designs are more leveraged than others, and some are less leveraged. The less leveraged ones require much less outside collateral, and in some cases, no collateral whatsoever. In some loan models, we'll have the client pay 25 to 35% of the premium out of pocket and then borrow the remaining premium, kind of like putting a larger down payment on a house and mortgaging less of the purchase. Now, again, we have 5 different loan models built for 5 different categories of client needs. Now, we even have some loan models wherein we'll use real estate equity as outside collateral, something very unique to premium financing. Currently, our rate is prime minus 1.5%, making it competitive with other traditional SOFR and treasury-based lenders. The second unique offering is that we have our back testing software. About a decade ago, I went around to all the carriers and talked to their advanced markets attorneys and their compliance departments and said, what I really want to do is build an educationally based tool that shows a client how policy charges and index crediting methodologies actually work, with floors and caps, and eventually with multiplier bonuses and asset-based charges. Because a carrier illustration only shows a static positive return every year. What I wanted to show was how cash value outcomes could be affected by volatility and a poor sequence of returns, more transparently disclosing these risks to the clients. Well, after multiple rounds of Q&A sessions with tons of carrier attorneys, we finally arrived at an agreement of what I could and what I couldn't show a client in order to stay compliant, especially with AG 489. So what keeps our software reports compliant is that we say that these are not life insurance illustrations, but rather a proxy for the real-world products. In other words, a fictitious hypothetical synthetic asset that behaves similar to real-world products. So we have a proxy for an IUL, we have a proxy for an equities and bonds account, and we use the actual historical S&P 500 returns as well as historical T-bond returns to model different outcomes in our proxies. Now, this may sound like overkill, but we literally analyze 121 different historical 40-year periods, tagging the 40-year period that produced the best compound annual growth rate and the 40-year period that produced the worst compounded annual growth rate. And then we also produce a synthetic 40-year period that starts off with the worst decade in modern history, the years between 2000 and 2009. This custom modeling creates scenarios that show the client a range of outcomes. So in addition to showing the client the carrier illustration, We believe showing the client different volatile scenarios, and the outcomes that they may produce is better than solely showing them a positive static return every year in perpetuity, which we all know will never happen in reality. So our proprietary software has the ability to show a client historical borrowing rates as well. It models the historical relationship between borrowing rates and index crediting rates, which is incredibly important in understanding both the benefits of positive arbitrage over time as well as the risks of negative arbitrage during years wherein the borrowing rate is higher than the crediting rate. Without this backtesting software, how would you ever really know if a premium financing design would weather the storm and the stress of volatility in a poor sequence of returns? To me, putting a client in a premium finance life insurance policy without this method of stress testing and backtesting is just plain irresponsible. So when you work with Lionsmark Capital, we put every single case design through this rigorous stress testing process using our proprietary software. It just makes you and your client sleep well at night, knowing that we did the due diligence that no other premium financing intermediary has the capability of doing. And lastly, the third thing that makes us unique is we produce a 30-minute custom video of me explaining your client's proposal using their actual numbers. Because at the end of every client meeting, they'll typically ask us to send them a copy of the proposal, which we obviously do. However, let's face it, they're never going to remember every single detail of what we discussed. And God forbid if they try to explain it to their spouse. I don't know about you, but every time I try to explain something to my wife that I'm not an expert in, I sound like the total idiot. So we produce this custom video where it's actually me going over their customized proposal, including everything from collateral to variable interest rates, using our backtesting software. We then upload this video to a private cloud, and then we send a link to the client so they can circulate it to their spouse, their CPA, their attorney, or whoever they want. And that way, they're hearing the explanation right out of my mouth, which ensures it's being articulated in an accurate, compliant, and transparent manner. The client can then pause, rewind, and rewatch any sections they want, which is great from an educational standpoint and from a compliance standpoint. And it makes it virtually impossible for you or me to be accused of not disclosing the important details, including the risks and the variables that this sophisticated strategy employs. So if you're asking yourself, why do my premium finance business with Lionsmark Capital? Those three unique attributes are attributes that no other premium financing intermediary has. And lastly, you also get me, personally presenting all of this to your clients at the point of sale. And to quote the illustrious Deion Primetime Sanders, if you kick me or pass me the ball, you're going to hear the band play, meaning that I will get the ball into the end zone for us. My job in working with advisors is to put points on the board. And I hope this doesn't come across as being cocky, but there is no one better at working directly with the client than me. Now, I know that's a big claim, but click on the About Us tab on our website here and scroll down to the testimonials section, and you can watch over 20 video clips of advisors talking about their experiences putting me in front of their clients. So if you're looking for someone to develop and expand your premium financing business, test me out on a couple cases for starters. And once you get a taste of my process, you'll never do business with another premium financing intermediary ever again. So I'm really glad you found us, and I look forward to helping you become even more successful than you already are. Again, I'm Darren Sugiyama, and this is our unique selling proposition. Okay, so now that you've seen the three distinct unique selling propositions we have, let's get into some case studies so you can see some actual loan models and also see which specific designs we would use with specific categories of clients. We'll also take you through a demo of our proprietary backtesting software so you can see how we communicate the due diligence that's done for our clients. Let's go ahead and get started. We have 4 different financing platforms. The first one is called First Dollar Financing, which is basically a 7-pay. This is a very generic design. Client borrows 100% of the premium. They pay the interest due each year.
and we typically exit the loan somewhere between year 11 to year 16, depending on age, health, and a number of other different variables. Second premium financing platform we have is called partial equity interest accrual. This is a 10-pay design, and I'll get into explaining how the mechanics work. Third design is called second year financing, which is based on the 7-pay model. And the fourth platform is third year financing, and this is based off a 10-pay platform. So let's go ahead and get into the first design here, first dollar financing. This case we'll review here. The intent is to have a low point death benefit of $10 million. So in this design, the total premium on a 7-pay is $2 million per year. We will have the client pay the interest due out of pocket each year. On an ongoing basis, they do have to post outside collateral that peaks out here just over 1.8 million. And then we're going to use the appreciated policy value to pay off the third-party lender in the 11th year. Now, what's interesting about this is that at some point, the policy value is going to hit a low point, as is the death benefit net of loans. As you see there in column 14, the death benefit starts out north of 26 million, and then it hits a low point right around $10 million. At that point, the death benefit was originally designed to continue to increase after it hits the low point. But what we find, even in a death benefit design, even if this is designed for estate planning purposes to pay the estate taxes, and the policy is owned in an ILIT, or an irrevocable life insurance trust, oftentimes what the client reacts to initially is the cost, right? The expense. So what we will oftentimes do, purely for emotional purposes, is we will show an income drawdown from the policy to recover 100% of their costs. So in other words, in this situation here, the total interest due cumulatively was $7.66 million. We are then going to show the client recovering that $7.66 million by taking policy drawdowns, and all the while, the low point death benefit never dips below that $10 million need. Now, the reality is, someone of this net worth level, they probably don't want necessarily or need to pull policy value down to live on, to retire on. Again, this is purely just an emotional design to help them see that their net cost on this is actually zero, because we're recovering 100% of their costs. What will typically happen is they will argue with me at this point and say, well, I don't need the income. I would just rather leave all that in the policy, outside of my taxable estate, in the ILIT, inside the policy, so that the death benefit is maximized to maximize the total wealth transfer to generation 2. And we will say, oh, okay, that's no problem. Then we can redesign it with no drawdowns. Again, the only reason we show this design with the cost recovery is to overcome the so-called expense, right? The cost of putting this life insurance policy in place. So that's really where we start. Usually when a client looks at this, one of the first objections that they might have is they say, well, I don't really need the life insurance. I'm wealthy enough to the point where what I pass on to my kids is enough. No one ever gave me a huge inheritance. And so we say, hey, we totally get it. The question is, do you want 40% of your estate going to the IRS, or do you want to maximize what's going to your kids? If you had to pick between the IRS and your kids, and I understand you're not necessarily all that interested in making your kids rich, but if you had to pick having the wealth that you built go to the IRS or more go to the kids, would you choose your kids or the IRS? Typically, they say the kids. So what we build them here is a scenario where we say, okay, if you do, quote unquote, nothing. In other words, if you just leave the money in your taxable estate in sort of some non-insurance based investment, and you contributed the same amount that you would contribute to the life insurance policy, in this scenario for a 10-year period, we're going to use some assumptions here. We're going to show the same 5.4% gross return that we're showing in the policy. We're going to assume a certain investment fee assumption, in this case 1.35%. We're going to assume 32% tax on the gains, and we're also going to assume that this client is at the 40% estate tax level. And we're going to show the same cost recovery drawdowns in the non-insurance based investment account as we are in the premium finance life insurance arrangement. What we have here in the middle is, again, in the left-hand column there, those are the interest payments the client would make in the premium finance policy, as well as later on the cost recovery drawdowns. The blue column there represents the after fee, after tax value of the non-insurance based investment account if the client were to die in any one of those years. Again, that's the blue column. The green column is the death benefit net of loans that would be going tax-free to Generation 2 if the client were to die in any one of those given years as well. And on the right-hand side, that line graph basically just shows the difference between those two different scenarios. Non-insurance-based investment account in the blue and the premium finance life insurance policy in the green. If we look at the 40th year here, this client is age 50. At year 40, they would be age 89. And at age 89, if they were to die in that year, they would be leaving behind $11.88 million more to Generation 2 if they opted for the premium finance life insurance policy, as opposed to investing that same amount of outlay in that non-insurance based investment. That is 392% more than the non-insurance based investment. So the question we'll ask the client is, are you really willing to have your kids take an $11.88 million loss? Again, same outlay, right? So when people say, well, the cost of insurance is this, or this is how much the interest expense is, or this is what the premiums are going to cost, it's really not a cost. It's a reallocation of funds that they would have parked elsewhere in some sort of alternative asset. So if that was the case, again, the difference between the green line and the blue line, pretty darn substantial. Okay. Next objection we might get is, what if we just bought a non-finance life insurance policy, right? Some clients say, at least, that they are debt adverse and that the idea of premium financing and taking out a loan seems risky to them. Well, we will show them an apples-to-apples comparison of what happens if they bought a non-financed, just a level $10 million death benefit policy. So in the orange there, we see for the same client, same exact product, same carrier, same everything. The annual premium on that is $146,000 a year for 20 years. And that would buy them $10 million of level death benefit, totaling a cumulative cost of $2.9 million in premium out of pocket, of which they will never reclaim. There are no drawdowns here. This is just to purchase a $10 million level death benefit policy that lasts all the way out into age 120. So again, $2.9 million in, kids get $10 million level. What we see here in the graph here is really telling, because the green bars represent the death benefit net of loans that Generation 2 would get in the premium finance policy. The orange bars represent the death benefit that they would get in the non-finance policy. And then the blue bars represent what Generation 2 would get if they took that same outlay and invested that in that non-insurance based investment account. The difference here, though, is that with the premium financed arrangement, remember, they're recovering 100% of their cost. So their net cost is actually zero to pass on, in this case, $15.9 million tax-free to Generation 2 if they were to die at age 89. Again, the orange bars represent the level $10 million death benefit policy, non-finance, that would cost them $2.9 million that they would never recover. And then the blue lines again, represent the non-insurance based investment account. So we always want to show them, all things being fair, apples to apples to apples comparisons, so that they can see just from an objective, indisputably mathematical perspective of what their logical options might be. Okay. Next objection we might get is, but life insurance is too expensive. Well, we did talk about the fact that it's not really a cost, because you're going to put that money somewhere, whether it be into a life insurance based design or a non-life insurance based investment. But what we want to show them is this concept of asset reallocation. Typically, when you're talking about a premium finance life insurance policy of this size, it's not so much coming out of cash flow. They are reallocating liquid assets from one portfolio into the life insurance design. So what we'll show them is this comparison here. So again, if they had a current portfolio Again, same design that we showed last time. 5.4% gross return, 1.35% investment fees, 32% tax on gains, 40% estate taxes, same cost recovery drawdowns. But if we started with a portfolio balance of $10 million, what we see here in the blue column is starting at a $10 million account balance, after taxes, after fees, after the return of 5.4%, in the blue column there, that's what Generation 2 would get, net of fees and taxes. In the green column right next to that is the exact same investment portfolio design. The only difference here is we are peeling off the insurance interest expense on the premium finance life insurance policy, right? So their account balances are going to decrease by that amount. We are going to cost recover, just like we talked about before. But then on the far right-hand column, that is the after taxes, after fees portfolio value plus the net death benefit. So again, it's just a reallocation of a very small part of their current portfolio just being repositioned into premium finance life insurance. On the right-hand side of the screen there, again, the blue line is the non-insurance based investment account with no life insurance. And the green line is the combination of the investment account after taxes, after fees, plus the life insurance death benefit. Again, with a starting account balance of 10 million on both sides, just by reallocating some of that into that life insurance strategy, the difference at age 89 is almost $16 million net. So very difficult for anyone to argue the indisputable math here. The only argument I typically will get at this point is they'll say, yeah, but I get more than 5.4% return in the market. Now, here's where life insurance agents have been somewhat hamstrung. As you all know, we can only illustrate the return in the life insurance policy up to a maximum of whatever the AG 49 maximum allowable illustrated rate is per carrier and per product. So what we have done is we have built a proxy for the, in this case, the IUL product. So we say the proxy is a fictitious hypothetical investment that behaves very similar to certain real world products, in this case, the IUL. So if I go back about a decade or so, I went around to all the carriers and talked to all of their compliance departments, all their advanced markets attorneys, all their actuaries, and said, look, what I want to do is I want to build a model that's more educationally based for clients, where we can explain to them how floors and caps work, how volatility can affect final outcomes. We want to show them how the charges are structured and how the charges work. And they said, well, you can't rebuild a life insurance illustration, right? That would be non-compliant. But you could build this proxy model that you're talking about, as long as you had the right disclosures. So that's essentially what we did. This proxy basically is built so that it behaves very similar to the IUL as it pertains to the contributions that go in would be the same as the premium schedule. The beginning of year charges are the same as the premium load charges. The monthly charges are the same as the remaining policy charges. The end of year credit would be the same as whatever the product's floor and cap would allow. We even built in there a participating loan option where we can model the depiction using the same participating loan rate as the product that we're evaluating. And then we backtest this. We use historical S&P 500 returns during 121 different historical 40-year periods, which I know seems like overkill, but we really wanted to be able to explain to the client, these are all the different outcomes that in theory could have existed based on the design of this product with all the volatility. And then lastly, we also can show historical borrowing interest rates. Now, this is extremely important when it comes to premium financing because all of the firms out there that were selling premium financing solely based on low borrowing interest rates, we're really doing the client a disservice. You don't do premium financing because borrowing rates are low. You do premium financing because you understand over time the spread or the arbitrage between the borrowing rates and the crediting rates. Well, when we go back and show historical returns and historical interest rates, in some years there was a positive arbitrage between the two, and in some years there was a negative arbitrage. what our backtesting software does, it can actually show with a client how that relationship works and how it has worked over time. So our model, again, we model 121 different 40-year periods. And then we tagged the 40-year period that produced the best compounded annual growth rate out of those 121 different periods. And we also tag the period that produced the worst compounded annual growth rate. I always like to focus on the one that produced the worst compound annual growth rate, just to be conservative. And I would always rather underpromise and then overdeliver. So in our model, we actually can extrapolate the charges and then model what the credits would have been in each one of those back-tested periods. So here's an example of what I mean by this. We have these charges and credits pages in our proposals. I know it's a lot of information here. But we can show them in this scenario here. Again, this is the 40-year period that produced the worst compound annual growth rate. This started right in fourth quarter of 1971. And what we'll do is break it down for them. So let's say in 1982, the S&P return was just over 37%. Based on a 0% floor and 10% cap model, the index credit in that year would have been 10%. So in this particular design with this particular crediting method, in that year, they would have gotten a $1.6 million credit. There were $42,000 and change worth of charges in that year. So the cash value gain in that year would have been just over $1.5 million. However, let's say in 1989, the S&P took a negative 12% hit, which means the policy would have credited zero. So in that year, there would have been $0 credited based on the index credit. There was a $58,000 charge in that year, so your cash value would have decreased by $58,000 in that given year. If we're using a product with, say, a multiplier bonus, in addition to the cap, you would take that 10% return multiplied by 1.96. That is the multiplier bonus, and so the effective index credit in that year would have been 19.6%. And the cash value gain in that year would have been $721,000. However, in a year where you had a negative return and you would have gotten a zero, well, 0 times 1.6 is still 0. They would have, however, incurred the multiplier bonus costs, which are pretty expensive. So in that year, the cash value would have decreased by $466,000. So we want to be able to show the client how this process works. And a lot of agents at first glance will say, Darren, this is too much information. My client does not want to know the details. Let me tell you something. This client's buying a $30 million life insurance policy, and it's going to have interest payments in the seven figures. They're going to want to know how the charges and credits work. And even if you don't think they do, years into it, if the client has questions or things just don't go as well as hoped, and the client becomes litigious, you want to have something in the client file that proves that you talked about interest rate volatility, that you talked about how a floor and a cap works, that you talked about how charges work. And so that's part of what my firm does as a service when you do joint work with us in premium financing, is not only will we have all these reports in the client file, we also produce a 30 to 40 minute custom video where it's my voiceover going over the client's custom proposal. We then upload that video to the cloud. We then circulate the link to that video so that the client can rewatch the articulation of how all of this works. They can pause it, they can rewind it, they can watch it a gazillion times if they want. They can send that link to their spouse. So their spouse hears me explaining it as opposed to the prospective insured explaining it. They can circulate that link to their attorney or their CPA or their idiot brother-in-law or whoever it is that wants to understand what's going on here. At least they're hearing a compliant, accurate articulation of how this actually works. We can even get into participating loans and how those work. So we show them here. In the 11th year, we're showing the bank payoff. We're showing the cost recovery drawdowns. And we have the ability to show the policy loan interest that's being accrued right next to the cash value gain that they're getting by leaving that money in the index account. What's really interesting here is over time here, over a 40-year period, the positive arbitrage between the participating loan amount and the index credit amount is over $31 million to the positive. And again, this was during the 40-year period that produced the worst compounded annual growth rate. I know this is a lot of data, might even be overwhelming, but I just wanted you to see that the due diligence has been done and is well documented in the client file. This is a great depiction here. So the dashed green line here is the simulated account value during the best 40-year period. The dotted green line is during the worst 40-year period. The blue line is the actual as illustrated cash surrender value in the carrier illustration. I think this is really encouraging because it really speaks to just how conservative that carrier illustration is, given the fact that the simulated cash value during the worst 40-year period out of 121 different periods we analyze is substantially greater than the as illustrated numbers in the carrier illustration. In addition to that, the black line is the as illustrated death benefit in the carrier illustration. So I find this really interesting because in a real world scenario, if the real world product had a cash value that looked similar to any of those green lines, if the green line eclipses the black line, the death benefit cannot be less than the cash value. It would automatically push the death benefit north of whatever the cash value actually was in a real world scenario. So very encouraging. Great way to stress test the product as well as the design. Now the solid green line here, this to me is one of the most important things to look at, especially in the environment that we're in right now. This is a synthetically constructed 40-year period. The first 20 some odd years start out between the years 2000 and 2021. And then after that, we're showing a static return of 5.4%. Why is this so important? The reason is that some folks are looking at life insurance in general and saying, hey, I think we're headed into a recession. I'm a little worried. Maybe this is not the right time to do it. In addition to that, they're saying interest rates are also high right now. So I'm paying a lot of interest, but not getting a lot of credit in the policy. Right? Well, that's what they think, which is why, again, historicals don't lie. So here again, we have the years 2000 through 2021. We have in column 12 there, the actual historical S&P returns. In column 13, we have applied the 0% floor and the 10% cap. Okay, after that period, then we're just doing a level 5.4% return. So if we blow that first 10 years up there, this is how bad it is, right? We got 1, 2, 3, 4, 5 negative S&P returns in the first 10 years of the sequence, in which case the policy would have credited 0, 5 out of the first 10 years, and even more specifically, 3 0% return years in the first 3 years back to back to back of the sequence. That's pretty adverse. But if we look at historical borrowing rates during that time, at least with one of our lenders, it tells a very interesting story here because in the year 2000, the borrowing rate is higher than the borrowing rates are today. But what happens, again, historically speaking, is as soon as there is a crash, there's a 2-year lag where the borrowing interest rate comes down, again, historically speaking, 2 years after a correction. So the borrowing rate went from almost 8% down to 4% and change, decreased down into the 3%. And then when we came out of that dot-com bubble, market had a 32% return, and now we see borrowing interest rates starting to rise again. Then again, we have the mortgage crisis, 2007, and then 2 years later, the borrowing rate gets chopped in half again. So it's really understanding the interrelationship between borrowing rates and crediting rates over time. This is the indisputable mathematical data that we have found is so important to show a client, because if you just hypothesize about these concepts, that doesn't give anyone any sort of real confidence. When you can show them indisputable math, that is really what pushes them over the edge in terms of really understanding what the real truth is in terms of the relationship between borrowing interest rates and crediting rates. Again, we go back to that solid green line. That tells a very, very valuable story. And then the last objection we might get here is that, well, I can get better returns in the market. We don't think that the life insurance death benefit IRR is going to be as good as if we invest it in the market. Well, okay, math doesn't care about your feelings. Math only tells you the truth, and historical math is indisputable. So on the left-hand side of the screen there, the green dashed line there, that is the greater of the as illustrated death benefit and the simulated cash value during the best 40-year period of the 121 periods we analyze. The blue line is the same contributions going into that non-insurance based investment account after taxes, after fees. On the right-hand side, same depiction there. That is during the worst 40-year period out of the 121 different periods that we analyzed. So again, if they're doing this purely for death benefit purposes, pretty hard to argue when you look at the numbers there. So I'm going to quickly go into the various other alternative premium financing platforms. Now that you've seen some of the back testing capabilities, we do this back testing modeling in every single design, regardless of what lending platform they're using. So let's get into lending platform number 2. We call this partial equity interest accrual. Okay? We're going to use the same client here. Difference here is this is a 10-pay design instead of a 7-pay design. $2 million in annual premium. The client is going to pay roughly a third of the premium out of pocket and borrow 2/3 of the premium, and then accrue the interest, meaning not pay the interest payments out of pocket. They're going to roll that back into the principal loan balance. The reason this can be a prudent thing to do is that the client does have a substantial amount of skin in the game, right? This is not 100% leveraged. The other interesting thing is if you look at column 9 there, the collateral needed for this type of design is substantially less than the first design. If you remember the first design, the collateral requirement peaked out at about $1.8 million. In this scenario here, very minimal collateral. And the reason is because it's not 100% leveraged, right? The client is paying in a third of the premium. We can still exit the loan in year 11. We can still recover 100% of the cost of the outlay. And we still have a low point death benefit north of that $10 million need. So the question might be, well, why would someone do this one instead of the first design? We're going to get to that. Before we get to that, I'm going to show you the 2 other designs we have here. Third design is, we call this second year financing. In this design, we have a much lower premium, much lower initial face too, but we still accomplish the need here. This is a 7-pay design, $1.5 million in annual premium. Client pays the first year premium out of pocket. Financing starts in year 2, hence the term second year financing. Client then borrows 100% of the premium in years 2 through 7, pays the interest out of pocket. Now look at the collateral column there. Now, is it possible that the client might have to post collateral? It's possible if they get some really bad returns, but it's not probable. And the reason is because you have so much equity going in year 1, right? They're paying the entire first year premium out of pocket. This is de-levering the overall proposition. Another way of looking at this is they are, I'm using air quotes here, they are posting the collateral inside the policy as opposed to posting it outside the policy. In this design here, we can still exit the loan in year 11, as you see there. The payoff amount is only 6 years of premium instead of the 7, which is why we can start with a lower premium. Still recover 100% of the costs, still have mission accomplished. Death benefit does not go below $10 million. Okay, and then design number 4, this is third year financing. In this scenario here, this is kind of a funky premium design here. It's $675 in years 1 and 2, as opposed to $1.5 million or $2 million. And then in years 3 through 10, it jumps up to $2.7 million. The client pays a level 675 each year. So in years 1 and 2, they are literally paying 100% of that reduced premium amount. In years 3 through 10, again, they're paying the same 675 contribution, which is 25% of the new higher premiums in years 3 through 10. And they're going to borrow 75% of the premiums in years 3 through 10, and they're going to accrue the interest. If we look at the collateral column there, again, minimal collateral. We can still exit the loan in year 11. We still recover 100% of the costs, and the low point death benefit is still north of $10 million. If we look at the comparison between all these different loan models, this is the death benefit net of loans value in this graph here. The black one is the first dollar financing, where they're borrowing 100% of the premium, paying interest out of pocket. The dark gray one is the partial equity interest accrual, where they're paying a third of the premium, borrowing 2/3 of the premium, and accruing the interest. The light gray one is the second year financing. Again, that's where they pay the first year premium of $1.5 million out of pocket. They borrow the remaining premiums and pay the interest due. And then the yellow line there is the third year financing. That's where they pay the $675, which is 100% of the premium in year 1 and 2. And then it is 25% of the premium in years 3 through 10. They borrow 75% and accrue the interest. If we want to look at the back testing, again, this is the best 40-year period that we analyze out of 121 different periods. And this is the worst 40-year period that we analyze out of 121 different periods. So the question then becomes, well, which one is best? The answer to that is there is no best, globally speaking. There is, however, a most appropriate, depending on the specific needs of the client and the specific financial situation of the client. So if we want to analyze these kind of side by side, if we look at the first year payment, out-of-pocket payment, plus the collateral the client needs to post, of the four, first dollar financing, one at the top there, it's the least out-of-pocket payment. However, it is the most collateral that they need to post. The third year financing, if you combine those two numbers together, has the least commitment in year 1. If we look at just in year 10, not cumulatively over 10 years, but just in year 10, the year 10 payment plus the collateral amount is still less in the third year financing design. If we look at the peak collateral, meaning the most collateral they would have to post in any given year, at least based on the carrier illustration, numbers, etc., and we look at the total outlay, the second year financing actually has the least amount of total outlay and the least amount of collateral need. So then the question is, well, when do you use each design with what type of client? The first design, the first dollar financing design, is really great. Let's say you have a client that is going to post AUM as collateral, right? They're an investment brokerage account. And let's say they have a bunch of unrealized gains in their portfolio. Well, they don't want to liquidate that because then they'd have to pay the taxes due. It would become realized gains at that point. And so they can just post their brokerage account with whoever is managing their money and then just pay the interest due out of pocket each year. So that design would be really great for someone in that scenario. The second design there, partial equity interest accrual, that's really great for a client that wants to just have a set level annual payment, right? They're thinking about this more from an annual budgeting standpoint. And they like the fact that the collateral they have to post is substantially less. The third design there, second year financing, why would someone want to do that design? Well, one reason, it's the least total outlay. Now, in reality, in each one of these designs, they all are recovering 100% of their costs through the policy drawdown. However, in this one, the upfront outlay is the least of these four designs. Most likely, they will have zero collateral. I mean, it's possible, but most likely they will have zero collateral. This design here is exactly what I did for my policy and what I did for my wife's policy. So we paid the first year premium out of pocket. We had the money. I didn't want to screw around with ongoing collateral or worry about that. And we paid the interest out of pocket each year. Now, just to give you some reference here, I'm not saying this is the best design. I'm saying this was the best design for me in my unique situation. The reason I really like this design, one of the main reasons, is that when there is a market crash, if the client is posting a marketable securities account as collateral, like so many clients do, when the market crashed, a lot of these guys lost 30% of their managed money account that was posted for collateral. So all of a sudden, they had to come up with another capital resource to replenish that investment account that they're using as collateral. For me, that didn't happen because when the market crashed, well, my cash value didn't lose 30%, right? Because I had the 0% floor. So in my design, which is, again, second year financing, I've never had to post any outside collateral, ever, even in the event of these crashes. So again, is it right for everyone? No. Is it right for the right type of client? Absolutely. Fourth design here, this is third-year financing. Again, level annual payments. This is the one where the client was paying $675 a year every year for 10 years. Requires minimal collateral and actually had the highest initial face amount and also had the highest death benefit net of loans 40 years out. So each design is a little bit different. Part of the service I provide when we look at designing the case is I want to talk to the client sooner than later, find out what their financial situation is, find out what their risk tolerance is, find out what their perspective is in their little crystal ball about what they think is going to happen in the future with the market, with interest rates, et cetera, et cetera. And based on all those preferences, I'm going to know what type of lending design to go with. That is then going to narrow down the carrier options and the product options. And it will also narrow down the lending options, meaning what banks we would use with each one of these unique designs. So kind of in summary here, if we look at the, again, total annual premium, to a certain degree, the annual premium doesn't matter all that much to the client because what the client's going to look at is total dollars in and then total dollars of benefit. But if we look at the total face amount, initially, the third-year financing has a substantially higher face amount for, relatively speaking, about the same out of pocket. With the higher face amount comes a substantially higher target than options 1, 2, or 3. The total client outlay is actually the least with the second-year financing option in the blue there, in the blue box there. But the third-year financing still is amongst the lower out-of-pocket designs there. And then if we look at the low point net death benefit, they're all right around 10 million. Third-year financing ekes out a little bit more low point net death benefit than the others. Not much, but a little bit more. Again, just so you can see a comparison. So again, very unique designs. Specific carriers work better or worse with these designs. Specific lenders work better or worse with these specific designs. Again, that is part of the service my firm provides. We will design the right strategy for the right client with the right product with the right lender. The last thing I'll get into here is what I would call unsuitable clients and unsuitable designs. This drives me absolutely crazy. There are firms out there and designs out there that have given premium financing a bad name because they were extremely irresponsible. This webinar I did, the client is accusing the premium financier and the agent of being really irresponsible. This was reported on in the Wall Street Journal as well as Forbes. You can actually Google premium financing lawsuit, Wall Street Journal, or Forbes, and you can read the actual article, or you can shortcut the process. You go to my website, lionsmarkcapital.com, click on Advisor Portal, which takes you into an advisor section of my website, and then you can click on Webinar Library. Here's essentially my point with these over-leveraged, irresponsible premium financing designs. So I ended up manufacturing this, again, using the same client profile we looked at before. And this design, by the way, I don't do this design. Okay? This is pure, I'm mimicking a competitor's design, and there is more than one competitor out there that does this type of design. I'm showing a severely lower borrowing rate several years out, which may or may not happen, right? I would not want to sell a case based on promising or even inferring that the client might get a 2.5% borrowing rate 11 years out. Okay, peak collateral 13.5 million versus $1.8 million is the high point of my design. But then we ran this assuming that the borrowing rates dropped to 5% instead of 2.5%. I'm showing here the worst 40-year period of all the periods we analyzed here. Now the peak collateral is 19 million instead of 13 million. And after you pay the loan off, the client's going to have to come to the table with an additional almost $17 million out of pocket versus between $6 and $7 million out of pocket if this is designed more conservatively. So do you want to take the risk and do all this? I mean, in theory, you could, but here's what happens when you sell a free insurance deal and then the client finds out it's not free.
Okay, so I hope you enjoyed today's webinar. And after seeing our capabilities, I think it's pretty obvious that we do a lot more than other premium financing intermediaries in this space. Now, I'm sure you have some detailed questions about how we would work together on cases. So get with the person that you invited you to this webinar, and they'll coordinate a private Zoom Q&A session with me personally. And if you found us on your own through an online search or something like that, you can reach out to us directly and call my office, and they will schedule that private Zoom call between us as well. You can call us at 949-398-0088. It's right here at the bottom of our screen here. Or you can go to our website at lionsmarkcapital.com. That's also right here at the bottom of the screen. And you can click on About Us or Contact Us, and you can request a private Q&A session with me personally there as well. But in any case, I look forward to meeting you one day soon and providing the very best premium financing solutions for you and your clients. Enjoy the rest of the day.